Very pleased to be able to speak with Bill Reichert, the Managing Director, co-founder of Garage Technology Ventures. Our conversation is going to be a little complex. We're going to talk about valuations, the impact of the pandemic on venture capital generally. And also I want to test your ideas on a couple of things, where technology is evolving and how you take positions in things that are disruptive. Maybe you can start by giving us a snapshot of your background.
I came to Silicon Valley as a student. And it was while I was a grad student at Stanford that I wound up starting a software company. I had no intention when I came to Stanford of starting a company, of being an entrepreneur. I thought I was going to go back to Wall Street or Washington and do high finance or public policy. I was doing a project for a venture capital firm while I was a student a long time ago, when the PC had just emerged as an alternative platform for computing. I had grown up, frankly, learning computing on mini computers. So that was kind of my era, learning how to program and learning computing in the mini computer era, which is to say during the 70s and early 80s. So the PC comes out, and I was complaining to this VC about the fact that there was no good software for the PC. You couldn't do any serious kinds of analytics. All you had was a spreadsheet. And I said, somebody's got to figure out how to develop serious business applications for the PC. And the VC said to me, well, Bill, why don't you do that? And I thought, well, okay, maybe I guess in my spare time, go solve this problem. And then I can go graduate and go back to the East Coast. One thing led to another, and wound up starting up a company, which was a software company. We were actually the first app development company for the PC. Our business model was to develop a matrix of applications for the PC that would be appropriate for the enterprise. It was a blue ocean, and the company just took off. We crashed and burned, and the whole thing blew up. That was my initiation into entrepreneurship, venture capital,
right,
and Silicon Valley. And
in those days, when you say app development for the PC, what apps were you working on? As you say, the whole world opened up to you at that point.
Originally, the whole idea was financial applications. Before business school, I had done a stint at McKinsey Company as a research analyst. I wound up being their analyst for their mergers and acquisitions program in the Los Angeles office of McKinsey, which was the practice leader for mergers and acquisitions. I wrote a bunch of programs specifically to do analytics on mergers and acquisitions. I did this on mini computers. Time passes, and now we have the PC. The big idea was to develop financial applications for the PC. The great thing about entrepreneurship is you never actually wind up doing what you plan to do, right?
At the same time, you sort of gravitate to something that is you. That's the whole idea of being an entrepreneur.
Of accidents, but we wound up writing the first Rolodex software. We were at a trade show, and these guys show up and say, hey, we were thinking maybe people would be interested in managing their contacts on a personal computer. Could you guys help us write this software? And we said, yeah. So we wrote the first Rolodex software. Charles Schwab came along and said, hey, do you think people would be interested in managing their money on a personal computer? And we said, yeah, we can do that. So we wrote the first software for Charles Schwab called Money Manager. And then Dow Jones came along and said, hey, do you think people would be interested in doing their bookkeeping on a computer? We said, yeah, we can do that.
Does that universe still exist in Silicon Valley? Is there a new frontier where things like AI or blockchain, we've got this ability and someone comes along and says, can you put this on blockchain? Can you put, can you build, and then a whole range of applications are born because of that.
Right. Well, every generation of compute technology has spawned a new generation of app development. Fast forward, when the internet came along in the 90s, everybody said, ooh, we've got to have something on the internet. Initially, it was brochureware on the internet, but a whole industry sprouted around enabling companies to get on the internet. The companies couldn't do it themselves. Third parties had to do it.
Since we're on this topic, where is technology today? Given that the entire 1990s applications had evolved into enterprise applications. About 2008, after the iPhone and all the mobile devices came about, it all became frontline technology, the technology that sits on a mobile device. I ask this because in banking, for example, right up to the mid-2000s, there was this whole thing about core banking systems. They were monoliths built. The application was built around the way in which the enterprise was structured. Today, the application has to sit outside the enterprise. So it needs to be developed quickly, deftly. It has to sit on the device, and the institution buys from that. Where's the Western world? I say Western world because the Chinese world seems to have really gone into the mobile universe very easily, very quickly, very intuitively. And then there's this whole enterprise culture. Where is that? If you take companies like Oracle, relational database, which is really enterprise. And then now they say cloud and community. Give us a sense of how do you think that evolution has evolved? Where is it right now?
I don't know what the right metaphor is. It's sort of like a wave, which is to say that the base of the wave that comes up more slowly than the crest of the wave. The crest of the wave is what we all see. In the 90s, we got the evolution of e-commerce and eventually this evolution of financial applications on the internet. PayPal is sort of the early version of that. Since then, lots of other financial applications, almost all of which have been sort of the front edge of the wave. The underlying infrastructure of finance banking evolves much more slowly. In the innovation world, it's relatively easy to develop applications and software that sits at the front edge of the wave in terms of the interface between the infrastructure of the financial services industry and the consumer, whether the consumer is an individual true consumer or a small business or even a larger business. That interface is much more dynamic in terms of what technologies can be implemented there. Back at the infrastructure, that has moved slowly. So the underlying plumbing of the financial services industry, certainly in the West, is very old.
I also ask this because in finance, manufacturing, and so on, there was a time when the SAPs ruled the waves. You had the core banking players and so on, and institutions dedicated large amounts of resources on that. Now it's possible to start a digital bank with just 5 people, entirely on the cloud. And the rules have changed. The rules are that you create a community of developers, community of users, community of APIs around a basic application. And that application, in the old days, you would start by saying, okay, where's the general ledger? Where's the basic information on the customer sitting? And then you build everything else internally as a stack, one on top of the other. And now you don't stack it. It comes and it goes. It's a universe and so on. And it just takes 5 people to start a digital bank today. But every digital banking initiative of a traditional bank involves armies of people who are trying to do 2 things. They're trying to protect what they have built as an enterprise architecture, and they're trying to get into the new universe of the cloud, the ecosystem kind of a thing. So, do you see that transition? Do you see that transition taking place? Do you, how many? While you're doing that, can you give us a sense of how many companies you're invested in? What's the size of your fund? That sort of thing. Some background as well.
Through the end of the last century, I was an entrepreneur. I wound up doing 5 venture-backed startup companies. And then after my last company went public, I got together with Guy Kawasaki and a few other people, and we started Garage to be a different kind of venture capital firm. And we had, all sorts of radical visions as to how we were going to change the venture capital world. So our first investment was in January of 1999. And then we filed to go public in February of the year 2000. I mean, it was an insane period of time. So So fast forward, we've had 5 funds in Garage. We've invested in, something over 150 companies over the years. We have several brand name success stories. Sort of our most famous success story, because it's a consumer brand, is Pandora. We were the first investors in Pandora. We had several even bigger successes on the enterprise side. I connected with a global venture firm originally out of Japan that set up its global headquarters in Silicon Valley called Pegasus Tech Ventures. Pegasus invests all over the planet. They have a big office in Southeast Asia. They've invested in over 40 companies in Southeast Asia. I sit on the board of a company in Vietnam for Pegasus. And they invest in Japan and Korea and elsewhere in the world, as well as primarily in the US. And so I have had the wonderful opportunity to invest across the entire spectrum,
Right.
from very raw startup seed stage, 2 guys in a garage, through pre-IPO companies. Earlier this year, we invested in SpaceX. So, a pretty broad gamut. Have done life sciences, have done material science, have done robotics and AI, have done quantum computing, have done fintech and ag tech.
When you invest in such a wide range of technologies,
Yes.
What sort of a kind of a game plan that you see evolving, and what are the elements that you pay attention to, that you pick up from?
Yeah.
In terms of where the technology is, in terms of where it should be today. It was easier days in the 1990s, where all the work in technology had the mindset of how do we map this into an institution, and today is just not that. But then you have the legacy institutions.
Broadly speaking, the biggest trend in the venture ecosystem has been that every single corner of our world has now opened up to technological innovation, potentially disruption, to venture capital investment, to entrepreneurial involvement. And my point earlier was sort of back in the old days, right? Back in the 80s and 90s, the tech industry and the venture industry were pretty narrowly focused on, IT, broadly defined, information technology, broadly defined, communications technology to some extent, including networking and all of that. The internet came along and it opened up sort of these new classes of business model. And so e-commerce was not technological investment, right? E-commerce was not investing in technology. E-commerce was investing in business models. It was investing in, a way of doing business on top of an established technology. And sort of with that transition, then you fast forward the mobile era. You had, the evolution of Web 2.0, which was primarily a laptop experience intersecting with social, and then the smartphone coming out. And then, that whole evolution of moving your internet access to the smartphone, which made a huge amount of sense globally. It was less dramatic in the United States and Europe than it was in the rest of the world, because the entire sort of infrastructure of the internet had evolved on the laptop. And so, right, everybody in the US and Europe had a laptop and a credit card. And so, that meant that the emerging economies, primarily China, but also the rest of the world, had a chance to leapfrog technology and be sort of unshackled by the infrastructure that we had grown up with in the more traditional laptop-based internet, e-commerce, fintech models. And so in a lot of ways, you saw much more innovation in outside of the US and Europe in terms of the impact on daily life of digital technology. as compared to, as compared to the US. It's like way more dramatic. I mean, it was a 10x drama, obviously in China and India and Southeast Asia and the rest of the world.
Do you think that PayPal today is innovation or still frontier technology? And the reason I ask is when I look at PayPal, by securing payment on the website, which was a big breakthrough at that point, but eventually the back end now is so credit card centric that it feeds right back into the the legacy credit card universe. It's just a digital version of that, and it's so comfortable for PayPal that if you compare them to say Alipay, they just won't evolve. So are there technologies that you invested in or you were part of in the early 2000s that are today legacy?
It's sort of the other way around. We one of my favorite initial pitches. It was in the year 2000, and I was at a conference in Chicago, and this group of guys came up to me and said, "Hey, Bill, we are going to disrupt a $30 trillion industry." The name of the company was Rocket Check. In the year 2000, technically PayPal had just been born, but the drama was the internet. A huge percentage of financial transactions in the United States were being done by physical checks. It was extremely rare that there was direct deposit kind of payment, back then. And so these guys, their big idea was, it's the 21st century. We're going to transform payments, and we're going to make all payments digital. Fast forward, it's still a challenge to this day, is that the infrastructure for payments is owned by the legacy players, right? Your point about, sort of the new generation of banks. You can, 5 guys can start up a new bank. Yes and no, right? I mean, what you have to do if you want to start a new financial play is you got to go find this legacy player who will give you a home that, a base you can operate out of that is compliant with all of the local and international regulatory regimes. And then you sit on top of them as a, maybe exciting sort of novel interface, but you haven't really made a dent in terms of the underlying infrastructure.
Given that there's so much legacy and there's so much regulation today in a number of industries, not just finance, venture capitalists like yourselves, to what extent are you, do you have the dare in you still to break rules, to move the line a little bit, to test regulators, and push things even a little bit. I mean, there was a time when the Ubers of the world will go in and set up a informal taxi network without permission and then work out. But today, I get the sense that lots of VCs almost factor in the legacy regulatory thinking into them. And then the final product that you look at is not innovative at all. It's incremental, if anything.
Right. Our job is to invest other people's money into companies that will generate a 10x return. And so, as I love it when I get the opportunity, for example, to invest in quantum computing. I know it's going to take a long time for that to play out, but I also believe that we're at an inflection point in some of these technologies that within the span of venture investing, we're going to get a significant increase in the valuation of these companies within the next 4, 5, 6 years. Our job is not to change the universe. Our job is to find entrepreneurs who can change the universe. And if an entrepreneur comes to us and says, I have this disruptive technology that if only the regulations were different we could, transform this sector of the economy. And, as an investor, we've made a couple of investments on the presumption that policy was going to move in our direction. And almost always, that's a dangerous assumption, that policy will move in your direction. It's appropriate for investors to take into consideration regulatory requirements. Now, we can inveigh against regulation, government bureaucracy, and all of that sort of thing. But, to put our limited partners' money at risk because we think that the politicians haven't done their job, that just doesn't make sense. I love working with entrepreneurs that are thinking outside the box, that are not, constrained by the current legacy infrastructure. I love looking at those opportunities. We've done that several times to great effect, particularly in the material science space. But when you're talking about regulatory environments, that's tough. 10 years ago, as the smartphone came out, and finally e-wallets came out in Europe and Japan, around the same time as PayPal came out in the United States. The United States just never got excited about e-wallets until smartphones came along. Then there was a little bit more enthusiasm, about the e-wallet model. It's still not that big a deal in the United States. But the idea of trying to go against the grain in terms of one, regulation, and then two, sort of user enthusiasm doesn't make sense for an investor.
In a lot of industries, there seems to be a slowing down of disruption and more of of an incremental thing. In fact, just this week, Alibaba's Ant Financial, they were forced by the regulator to drop the word financial and to be called Ant Technology. China is also solidifying now, so it's becoming more conservative. That era of the Alipay and so on is now over. It's officially over. And it's going back to the traditional players and so on. Yeah. So I'm just wondering to know the VC universe, whether you're on the lookout for things that are disruptive. Right. That you would have at least 2 or 3 companies in your portfolio that
are potentially most disruptive investment. Well, we have a few. One is SpaceX, and it's astonishing all of the things that they're planning to do, and sort of now that I'm an investor in them, as and when they actually do that, it's going to be amazing, right? An important aspect of SpaceX, which is, so much of what they are doing, the rules are relatively open, and there are very few legacy players, right? So, they're aligned with their partners. They are very much aligned with NASA, right? For example, there aren't really legacy players out there unless you consider, sort of Boeing, kind of a legacy player that they're competing with. But it's very little that you have to, overcome there. Another example is a company less well known we've invested in called Vicarious. So Vicarious is a AI robotics company that, I think lots and lots of famous Silicon Valley people have invested in Vicarious around the idea of leapfrogging the path of progress of smart robots. So Vicarious is a team spun out of Stanford that believes that traditional deep neural networks are a dead end. They are, highly limited in what they're going to be able to do. And so AI requires an entirely new framework for computing decision making around robots. And so it's very transformational in terms of the architecture and the approach that they're taking. Their business model is pretty mundane. Their business model is robot as a service. And so you don't have to buy and install and configure and program and develop, $150,000 just to get a robot working on your production line. The big idea is $2,000 a month, and here's a robot, and it can go, in 30 minutes, it can figure out what it's supposed to do, and it will just do it all day, all night, tirelessly, never making a mistake, right?
Actually, you just pointed out something very interesting, which is the more technology we see, the more we see in terms of AI and robotics and so on. There's a kind of a price destruction taking place. It's actually to commoditize business models and make it more available to more people. So AI doesn't mean more revenue. AI means democratization. It means price destruction. When you look for sustainable business models that you can cash out on. In the networking days, it was critical mass, number of customers, number of I views and yeses and stuff like that. What do you look for now? I mean, is it the technology? Is it the ability to amass large user base?
So venture capital has a very clear set of criteria, which is that you invest in companies that can grow very rapidly, achieve scale, and have disproportionately attractive economics. It doesn't matter. I mean, it doesn't matter if you're selling it for 99 cents a pop or for $999,000 a pop. You want to price it to optimize that end objective, which is to deliver disproportionate rents in an economic sense, right?
Right.
So what's the price point? What's the price point that's going to ultimately generate the greatest value as a company?
That's great.
And so, the great thing about software, and this is the reason that digital has transformed our economy, which is if you can develop an application or a solution that delivers value, the marginal cost of delivering that application to more people is almost zero, right? You have a customer acquisition cost, but unlike, selling the next car, selling the next house, or selling the next boat, or whatever it is, selling the next subscriber is a wildly different economic than, sort of in the physical world. It's a win-win in economic terms that we can deliver substantial incremental value for virtually no incremental cost. Right. That is, good for everyone.
There is the universe that was evolving just before the pandemic hit. And in fact, when I look at the numbers, we see dry powder has been, growing very well. But invested, investments was actually sort of tapering off a little bit. It was softening in 2019. You have that. And then, curiously, a few of the startups were being valued very well, and I actually thought that it was companies like SoftBank that were providing the benchmark valuation where everybody else was trying to reach that. And then when SoftBank sort of got off the scene, everyone's lost somewhat. Now you have, as part of the pandemic problem, the US government putting in a lot of liquidity into the marketplace. And this liquidity might be different from the 2008 liquidity. And in fact, right now, as we speak, the stock market is doing very well in the US. And it actually seems to be rewarding the digital companies. Talk to us a little bit about where valuations were in 2019, where they are as a result of the pandemic, and who are the players, like, the stock market, the series players,
Yeah.
and the VCs and so on.
Let me first tell you that the aggregate numbers that you see on venture capital investing are wildly misleading. So, I mean, they tell you very, very little, because the aggregate numbers that you're looking at are overwhelmingly the numbers associated with late stage investments in unicorns. And so if you burrow down inside, you can see, some other data on what's going on at the startup level, at the, seed and early stage level. And unfortunately, for a whole bunch of reasons, the data collection on what's going on at the venture ecosystem it's not very good data. There are just so many accelerators and incubators, and so many angels and angel groups, and so many corporate players now, and so many new small funds, that it's really hard for you to get a real sense of what's going on from the data. So when I look at what's going on in the venture ecosystem, I make this very clear differentiation between what's going on at the top, sort of at the unicorn level, where the really big players, the late stage funds, which make up, more than half of all the venture capital, is dedicated to late stage. And that's, and that's limited to several hundred companies globally, basically. And some of those are interesting, exciting companies, and they're highly relevant, but it doesn't give you a great sense of the underlying innovation ecosystem. So at the top of this ecosystem pyramid, yes, valuations got crazy high, and they're still amazingly high. The problem for us as sort of traditional venture capital investors, the problem for us is venture capital as a class is such a tiny asset class that as soon as the big guys decide, oh, let's allocate more money to venture capital, it swamps the class because it's such a tiny class. This is unfair, but sort of the true startup ecosystem capital domain is less than $50 billion a year. But you put in all of these new players with all of their big checks, and it swells it to something over 200 billion globally, with all the late stage money going in. So that it's just a very distorted perspective on what's really going on. So having said that, because there's been so much money coming in, it has been for the last 6, 7, 8 years, it has been an entrepreneur's market. There's been so much new money coming in that entrepreneurs, once they cross a threshold of fundability in terms of, having validated that they've got a technology that delivers compelling value, then, it's been relatively easy for them to get these inflated prices. So there's that whole class of players out there. And, it's also partly our fault on the VC side. As soon as we see a sector taking off, then, there's a herd mentality that you want to say, why haven't you already invested in a food delivery startup? Why haven't you already invested in a personal mobility startup? Why haven't you already invested in an autonomous vehicle startup? Why haven't you already invested in a robo wealth advisor startup, right? So pick a sector, and there is this unfortunate tendency by the community to want to have a toe in all of these emerging sectors as they come out. That's created what is now affectionately known as the Gartner hype curve. Technology has never evolved and progressed as fast as we think it has. I mean, we have this this myth in our brains, that we grew up with, which is that the pace of technology continues to accelerate. Well, no, it doesn't actually move that fast, So product release cycles have accelerated, competition has accelerated, globalization has accelerated, revenues globally have accelerated, but the pace of technology does not move as fast as investors and entrepreneurs think it does. Yeah.
Take a blockchain, for example.
Yeah, right.
So
right.
just listening to what you just said, every
Right.
VC, will pay homage to blockchain. And then as you see all the different blockchain initiatives evolving, what I see at least is number one, a lot of it is just software. It's actually a shared ledger. The second is every blockchain initiative is an on us initiative, meaning that each one of them want to create their own universe. So without kind of a connectivity, it's going to be years before you start seeing the real benefit of blockchain. And then of course it's hampered by the fact that the technology itself is not mature to be fast, to be usable, and so on.
Right.
So do you look at blockchain companies, and when you do, what are you looking for?
Yeah. I mean, so okay. Remember, when did the world learn about blockchain technology? It was 12 years ago. It has evolved. It's gone through these crazy cycles because of its attachment to crypto. And so, because of its attachment to crypto, it's had a somewhat different ride through our technological world.
They've decoupled it now. It's now again coming back to the question of enterprise. The enterprise has embraced it, owned it, redefined it. And then there's 1,000 different initiatives out there. It's become a regular software industry.
This is your point: is that it is just another app. I mean, and so if I decide to implement some sort of solution on blockchain infrastructure as opposed to Oracle infrastructure, or as opposed to a flat file infrastructure, or a non-SQL infrastructure, whatever, it doesn't matter. I mean, I still have the issue of how do I open that database to third parties? No matter what, you have this issue of how you open it up. And so blockchain has a different way of providing access than a traditional database does, which is sort of interesting and has some particular benefits in certain applications. We made a couple of blockchain investments. There is no magic in blockchain. And that's, and unfortunately, far too many entrepreneurs are religious about blockchain. And that's always scary to investors. I mean, that whenever an entrepreneur comes along and says that blockchain is going to displace, all infrastructure and Oracle is dead, right? I mean, I just stay away from those entrepreneurs who, for years and years and years have said the legacy banks are doomed. They are dinosaurs. They will die. And, it's not going to happen.
Coming back to valuations and where do you find the anchor pricing mechanisms, right? And so again, I want to add in the fact that it's a low interest rate environment right now. Lots of quantitative easing or equivalent out in the marketplace. Huge liquidity. Do you think about all these things in terms of the institutions and the exit mechanisms that are available now? To what extent is that M&A for you? What's unique about how Garage does its exits?
Yeah, the point you're making about the global liquidity is related to the point I was making before about how small the venture capital asset class is, and how a little bit of incremental capital swamps the rest of us, right? And that's the world chases returns. Right? We know that, and we've seen this after cycle after cycle. And right now, it's really hard to see what asset class is going to be giving you good returns in the future. So equities seem pretty fair, pretty highly priced right now. In spite of the fact that the stock market is doing, shockingly well. I mean, there's a huge pool of cash that is sitting on the sidelines. How in the world can Boeing be doing as well as they are? I mean, so, it's just, there's no place to put your money right now.
How has COVID, played out for you? And how's that changed your business? What do you spend time on? Yeah.
Again, because we're venture capitalists, we're investing for the long term anyway. And, the irony is to some extent that because of COVID, we've been flooded with entrepreneurs who say, I've got the perfect answer for COVID, right? Whether it has to do with, video conferencing or food delivery or therapeutics or, personal protective equipment. I mean, we had just all these entrepreneurs who've decided, we're going to pivot and address the COVID crisis, but that's not the type of thing we invest in, right? So it hasn't fundamentally changed our investment thesis. There are things on our radar in the hospitality, personal mobility space. We're not abandoning anything, but we are trying to understand where the world is moving and how this larger crisis is going to play out. So almost certainly we're going to go into this world that is going to be very different than it was before COVID in terms of economic growth or lack thereof. We are certainly going to go into a prolonged, economic downturn of some sort. We may hit, before the end of the year. It's going to take a long time to crawl out from wherever that bottom is, and who knows where that bottom is, right?
Yeah. So in the companies that you already invested in, what sort of trouble are they in? Like, cash flow, operational, delays.
This crisis is very different than the meltdown in 2008, 2009. So in 2008, 2009, everybody got whacked. And, we weren't sure if the financial system was going to survive. And we would literally have board meetings worried about where our cash was banked. Right now, on the other hand, the impact of this crisis on early stage companies is, highly variable depending upon where you are in the market. We've been very fortunate that none of our companies totally whacked by this thing, partly because they had raised money last year and they then had the ability to hunker down. So depending upon your timing, if you had enough cash in the bank when this thing started and you got whacked, then you can hunker down. But we're hoping, what we're telling everybody is, if there's any way you can make it to next summer, the summer of 2021, design for that. Do not assume this thing's going to be over this year. So what we're seeing is, there's some slowing down, but we're not seeing wholesale cancellations of software subscriptions or of licenses. Unlike when the bubble burst, and unlike 2008, 2009, where we had to just forget about any new investments and focus on the portfolio. Back during the global financial crisis, the venture capital industry shut down in terms of new investing, right? And just focused on the portfolio. That's not happening. And in fact, what I'm seeing is kind of an awakening where people are thinking, this could open up some interesting new angles in things like logistics and supply chain, or, obviously healthcare is an increased focus going forward. And frankly, it's pretty clear that pretty much all the governments of the world are going to appreciate that entrepreneurship, innovation, and investing in new technologies is the smart thing to do. All the data supports having public policy put a certain amount of resource into supporting entrepreneurship, innovation, disruptive technologies. There's tremendous research that supports that.
On the funding side, I mean, raising funds, how's that going? Has it become easier because of the interest rates and are there people coming in with bags of money?
I just had a long conversation earlier this evening with a good friend of mine who is at a different VC who just closed their new fund. And with a lot of the negotiation and attraction happening during the last 3 months while we were in this crazy period, right? There's a ton of liquidity in the world. There's just a lot of money out there trying to figure out where do we go. So as far as we're concerned, we haven't seen that the LP window. I think we're seeing caution. I think there is going to be a flight to quality or a movement to quality. I think for some of the newer funds, it's going to be harder. It is going to be harder for startup companies to attract capital. I think the angels are going to be more cautious. So I think there's no question this is going to slow things down, but it's nothing like the global financial crisis of 12 years ago.
I think you've described it well because what you're saying is that there is caution, but there's lots of liquidity. If you have experience, the funds are going to be gravitating to you. But then that puts pressure on you because what sort of yields would your investors be looking at?
Yeah.
What's the conversation on that like? Where are the investors coming from and what are they looking for? Like, are they just parking their funds with you or what?
Well, it depends on who the investor is. So with Pegasus, most of our investors are corporate investors, and so their focus is not on internal rate of return. Their focus is on making sure that they get a window into emerging technologies that are relevant to their business over the long term. So that from that point of view, the valuation issue is not a significant driving force. The driving force is we want to make sure we don't get blindsided by a technology that's going to be relevant to us, and conversely, we want to be early adopters of the next wave of technology that's going to affect our sector. So they're leaning in, if anything. In our world, it's about the balance sheet, it's not about the P&L. The family offices, they're all more cautious.
Right.
And I think in March, when the market just fell off a cliff, the family offices were pretty much in chaos. But I think the family offices now are much more comfortable this week than they were the last week in March. And so they're trying, they now can breathe because they're not looking at their portfolios going from down 25% to down 50%. They're now looking at their portfolios down 10% from the beginning of the year. And that's not a crisis. And so they're just trying to figure out what equities do we keep our on and what
I see that at least in fintech, there's a number of M&As which are distress driven, like models that didn't work and then didn't work even worse during the crisis, and and then there's been some buying and selling. Are there value buys in this environment for you? Like, are there things that you look at because they're cheaper now?
When I was a youngster here in the Valley, one of the grand old men founders of venture capital, he said, "Bill, look, there's no such thing as a bargain in venture capital. You get what you pay for. You cannot go bargain hunting in venture capital. He also, his other phrase to me was, don't worry about hitting every pitch. There will always be another good pitch. So a very baseball metaphor.
Who is this person?
His name is Reed Dennis. Reed Dennis was the founder of Institutional.
That's useful because in a way it's like the art market. You don't go into bargain with an artist. You decide what the valuation should be, and just going back to your original point about Garage Ventures, when you started it, you said you had an original intention which was to be different from the rest, from other VCs.
Right.
How's that playing out? Like, are you as different as you wanted to be?
We've reinvented Garage, every few years, whether we needed to or not. What had happened was that all the guys on Sand Hill Road had raised these bigger funds because all this new money was coming into venture capital. The godfather of Garage was a guy named Craig Johnson. Craig Johnson was the founder of Venture Law Group. He had spun 24 lawyers out of Wilson Sonsini and took them and Yahoo from Wilson Sonsini and set up this radical new law firm called Venture Law Group. So by the late 90s, Craig was getting frustrated because he would come across these two graduate students out of Stanford who had this great idea, and he would call up his buddies on Sand Hill Road and say, hey, let's put a couple of $100,000 into this company and let's see if they can make something. And they would say, Craig, 200,000, we can't write a check for 200,000. That's a crazy, we got to write a check for 2 million. Craig said, well, there's this incredible opportunity to create a venture firm that actually bridges between the angels and Sand Hill Road. And so our big idea was to fill that gap. And one of our original mantras was, we are venture capital, filling the gap between angels and VCs. At that point, venture capital, real VCs didn't do seed. We were overwhelmed with demand. And so we did this engine, this process to bring startup companies into. We would put in like $25,000 or $50,000, and we would run them through a curriculum. Basically, we created the Garage curriculum, and depending upon how experienced you were as an entrepreneur and where you were in terms of product launch and all that stuff, we would sort of run you through this curriculum. And when you were ready, we would then introduce you to our friends on Sand Hill Road. So
right.
our original investors were Sequoia and Mayfield and Draper Fisher Jurvetson and Silicon Valley Bank and Highland Capital. They were the ones who actually originally funded us to basically be the farm team for Sand Hill Road. And so we invested in like 130 companies in the first 3 years.
And that's become so complex now, isn't it?
No, well, that had happened. That was the phenomenon of the, prior to, it was always the case that, 70 to 80% of exits were M&A. And if you were lucky, you could get an IPO, but it was always M&A was the dominant exit. And then during the bubble, you had this unbelievable flip where you had this explosion of IPOs out of Silicon Valley. But then, that it was all hot air, and, that bubble burst, and we thought we learned our lesson at that point. And we sort of did. And so, fast forward to this last cycle, as companies became, more and more successful, what happened was they didn't have to go public. And in fact, they didn't want to go public. And you had all of this late stage money that came into the market, the PE guys, the Fidelities and the Goldmans and the T. Rowe Price.
Bigger than the market.
And then you had this this horrible phenomenon where the entrepreneurs could cash out through these late stage guys.
The stages, yeah.
And so like the guys from Groupon, so Goldman Sachs raised $900 million in a pre-IPO for Groupon. 450 million of the 900 million went to the founders. It was obscene. It was crazy. And then all of those Goldman Sachs investors were underwater after the IPO. The company went public and then it went down.
You've just introduced the one element that I wasn't looking at the founders themselves, at which point they reward themselves and stuff like that. Actually, This has been an amazing conversation. Just one more part to it, which is Garage Ventures globally. Is Silicon Valley where you want to be? Is that where the good deals are still? Are there much baseline deals which you can scale other parts of the world? How do you see international from where you are?
Yeah. Well, two quick points. The first point is, because the world is now a much more open opportunity for innovation and entrepreneurship, that's a key part of why I am now also at Pegasus Tech Ventures, which is a global venture firm. So, Pegasus gives me that much greater global reach than I can with just Garage. There is a lot more opportunity globally than there was, 10 years ago. The second point is the really interesting thing about this crisis is now, I get up in the morning and I'm on a Zoom call with Israel. And then during the day, I may be talking to New York and Boston and Minneapolis and Southern California and San Francisco. And in the evenings, I'm on a Zoom call to Taiwan or Japan or Singapore for that matter, right? And what's really interesting is the experience, whether I'm talking to Israel or Singapore or San Francisco, it's the same experience.
Same issues, yeah.
This crisis has flattened the access of entrepreneurs to investors and of investors to entrepreneurs globally. And so, I get a pitch from Germany for this AI manufacturing technology, and they could be in San Francisco. They happen to be in Germany. And that night, we hook up with a company in Taiwan and say, hey, you got to look at this technology. It's extraordinary technology. And, in the olden days, we wouldn't have even thought about doing that. And maybe we would have had a conference call, but now the standard is to actually look at the other people and to have, thanks to the video conferencing, which has gotten, much better, still not perfect, but
it works. Yeah.
Right. It's a very different experience. And I think this crisis is going to accelerate, I think it's going to accelerate the globalization of venture capital. So, we had some globalization and that's sort of stalled out. And
what you're saying is that venture capital is not as global as it is as yet. Thank you very much, Bill.